I analyzed a Bitcoin Treasury company trading at 4.2x mNAV that looked perfect on paper. BTC Holdings, 2,400 coins. Year over year BTC yield, 180%. Balance sheet looked clean. I almost bought in. Then I found the one thing that changed everything. Their debt maturity wall was 11 months out. BTC was their only liquid asset. And they had zero capacity to roll the notes. That 4.2x premium wasn't pricing in growth. It was pricing in survival. Stay with me. This breakdown is going to save you real money because right now in August 2026, there are 5 Bitcoin Treasury companies all trading at meaningful premiums to NAV, and almost nobody is asking whether those premiums are actually earned. Let's start with the math because the term gets thrown around loosely. mNAV stands for market cap to net asset value. The calculation is simple. Take the company's total Bitcoin holdings, multiply by current BTC price, subtract net debt, and that's your NAV. Then divide the market cap by that number. If a company holds 1,000 BTC, Bitcoin is at $150,000, and they have $20 million in net debt, NAV is $130 million. If the market cap is $390 million, mNAV is 3x. A premium above 1x means you are paying more for the stock than the Bitcoin it holds is worth on a per-share basis. So the obvious question is, why would anyone rationally pay 2x, 3x, or 4x NAV? There are 3 legitimate reasons. First, BTC yield. If the company is consistently growing BTC per share through smart capital markets activity, the premium reflects future accumulation. Second, operating leverage. Some of these companies have underlying businesses generating cash that funds additional BTC purchases. Third, liquidity premium. Holding MicroStrategy or Metaplanet stock in a brokerage is easier than self-custodying Bitcoin for certain institutional investors. But here's what mNAV hides. It tells you nothing about the quality of the debt used to acquire that Bitcoin. It tells you nothing about dilution rate, and it tells you nothing about whether BTC yield is real accumulation or financial engineering. That's where most retail investors stop reading, and that's exactly where we're going to go deeper. Let me walk through 5 companies right now. I'm using data as of this week, August 2026. Company 1, Metaplanet. The Tokyo-listed firm now holds approximately 16,200 BTC. They've been aggressive, issuing stock acquisition rights and yen-denominated bonds to fund accumulation. Current mNAV, roughly 2.8. Debt to BTC value ratio, around 18%. That's actually conservative relative to their size. Company 2, Semler Scientific. They hold approximately 4,300 BTC. Semler is interesting because they still have a functioning medical device business generating around $40 million in annual revenue. That operating cash flow is real. Current mNAV, approximately 1.9x. Debt to BTC ratio, roughly 22%. They've been slow accumulators, which is why the premium is lower. The market isn't pricing in aggressive future purchases. Company 3, Nakamoto Holdings. One of the newer entrants went public earlier this year. Holdings, approximately 3,100 BTC. mNAV, 3.4x. This is where it gets interesting. They have essentially no operating business. The entire premium is a bet on management's ability to raise cheap capital and buy more Bitcoin. Debt to BTC ratio, 31%. That's elevated. Company 4, Bitcoin Depot Treasury Corp., rebranded from a fintech operation 12 months ago. Holdings, approximately 1,800 BTC. mNAV, 2.1x. They carry convertible notes at 6.5% interest, maturing in 2028. The debt structure is manageable, but their BTC yield over the past 4 quarters has been just 24%, the lowest of any company on this list. Company 5, Sol Strategies BTC subsidiary, carved out as a separate listed entity. Holdings, approximately 900 BTC. mNAV, 4.66. Highest premium on the list. Smallest holdings. We'll come back to why that premium exists and whether it makes any sense. Here's the 3-factor model I use to evaluate whether any given premium is justified. I score each factor from 1 to 5, then add them up. Maximum score is 15. Minimum is 3. Factor 1, BTC yield quality. This is the trailing 4-quarter BTC per share growth rate, adjusted for dilution, not gross BTC accumulation per share. Because if you're issuing 30% more shares to buy 25% more BTC, you are actually diluting existing shareholders on a BTC per share basis.